We used to call him Super Mario. Not anymore. He strode around Europe carrying a big bazooka, but he's gone and lost it. European Central Bank President Mario Draghi approaches this week's policy meeting with problems aplenty. Eurozone inflation has stalled, Germany has slipped into deflation, growth is painfully low, and his beloved euro is stuck in a rut. For a year now, it's been hovering in a band of around 110 to 115. That weaker, more competitive euro that Mr. Draghi needs to revive the Eurozone economy remains out of reach. But that's not all. His exalted reputation was pulled apart at the last ECB policy meeting when the promise of significant further policy easing failed to materialise. The euro, as we can see here, there's the policy meeting, soared 3% higher. Its biggest one-day rise in 6 years. So you would think the market would have learnt its lesson. But has it? That heightened expectation of policy easing pushed the euro 4% lower against the dollar in the month, as we can see, leading up to that December the 3rd meeting. Yet since mid-February, it's down 3% in the run-up to the March the 10th meeting this week, even taking into account the recent rise of recent days. But it means that if we get more policy disappointment this week, that currency is going again to bounce. It's been a painful couple of months since that December meeting. The great divergence, which many analysts predicted would send the euro towards parity sometime this year, is in no hurry to show its face, as global economic problems temper the pace of the Federal Reserve rate hike cycle. Market turmoil and uncertainty has driven investors to haven assets, the euro being one of them, while euro-funded carry trades have been unwound. Meanwhile, investors have given the thumbs down to the Bank of Japan's negative interest rates policy, which happens to be one of the ECB's few remaining policy tools. ECB-style policy easing looks bust. Yes, the euro has fallen by a quarter since mid-2014, when quantitative easing first crossed Mr. Draghi's lips. But coming after the Fed and the BOJ had their say on QE, the ECB was always going to find it a struggle to keep the market on side with its asset purchases strategy. Now, where does that leave the euro? Probably moving higher to around 116 by mid-year, according to analysts at BNP Paribas. QE last year helped pull the euro lower by driving debt outflows, offsetting the Eurozone's huge current account surplus. But in this risk-averse climate and moderate Fed cycle, investors this year are going to be less willing to hunt down better returns abroad. So a healthy surplus is going to push up the euro. Perhaps the ECB should accept that that 25% fall over 2 years in the euro is as far as it was going to go in this cycle. There are threats to the euro, after all, coming from elsewhere. The migrant crisis, Brexit fears. So maybe a euro that stays on trend is the best that Mr. Draghi can expect. But if he really is determined to get the euro lower, he will need to rely on the Fed to deliver a faster rate cycle. Mr. Draghi should hand that bazooka over to Miss Yellen, if he ever finds it.